SpaceX reported a 92% jump in revenue, but investors seem concerned about AI spending. Let's learn more.
Today, we're diving into a genuinely fascinating financial mystery surrounding SpaceX's Q2 2026 earnings report, where absolutely incredible success met a really surprising market reaction. It's incredibly rare to see a company post such fundamentally strong numbers, only to have the broader market immediately hit the panic button and sell. But that is exactly what happened here. And today, we're going to unpack exactly why. Okay, let's start with a number that is just absolutely jaw-dropping: $7.81 billion. SpaceX absolutely crushed their Q2 expectations with that revenue figure. To put that into perspective for a second, we're talking about a massive 92% year-over-year growth rate. They didn't just meet analyst expectations for this quarter, they cleared those estimates by almost a full $1 billion. It was a blockbuster result that just screamed overwhelming operational strength, effectively doubling their revenue compared to the exact same time last year. But here is the ultimate paradox. Despite that historic beat and narrowing operating losses, the stock inexplicably tanked 7% in after-hours trading. I mean, how does a company grow its revenue by nearly 100%, completely trounce Wall Street's top-line expectations, improve its operating losses, and still see its stock sell off so sharply? Well, to figure out what had the market so incredibly anxious, we've got to dig a lot deeper into these numbers. To solve this mystery, we actually need to look way past the rockets themselves and see exactly where the cash is flowing. It's so easy to think of SpaceX as purely just a launch provider, right? But their revenue engines have evolved so dramatically over the last couple of years, and understanding that shift is the very first step to unlocking the complete financial picture. Starlink is clearly the financial backbone here. It brought in roughly $4.3 billion and basically doubled its subscriber base to 12 million, driven heavily by strong enterprise and government demand. That's their recurring cash engine. But the real shocker? Their fastest growing business is actually AI. It generated $2.6 billion with a mind-bending 200% sequential growth. Meanwhile, the traditional space and launch division, that brought in less than $1 billion. Now, let's add a huge caveat there, because management emphasized that this launch revenue number actually severely understates the true value of the business. That's mostly because they're doing so many internal launches just to deploy their own Starlink satellites rather than serving outside paying customers. And that brings us to a massive operational win. See, Wall Street analysts were totally bracing for this notoriously expensive AI division to maybe reach profitability late in 2026. Instead, thanks to surging demand and rapidly improving margins, they hit positive adjusted EBITDA incredibly early, way ahead of Wall Street's schedule. So here's the crucial point. With revenue surging, full-year guidance officially raised by management, and AI turning an early profit, what on earth spooked the market? I mean, we have a company executing flawlessly across its major segments. There has to be a smoking gun in this earnings report that triggered that 7% drop. Well, here is that smoking gun. SpaceX genuinely shocked investors by spending a staggering $15.8 billion on AI capital expenditures. The market had braced for a hefty bill, maybe around $13 billion, but this nearly $3 billion overshoot, it was just a breathtaking display of aggressive spending in a single quarter. The market's concern wasn't that SpaceX is investing, it was terrified by the sheer scale of how much cash just walked out the door all at once. So where exactly is almost $16 billion going? This astronomical mountain of cash is being aggressively poured directly into infrastructure. They are partnering closely with NVIDIA to massively expand their GPU capacity, simply because the demand for compute continues to vastly exceed supply right now. We're talking massive GPU purchases, sprawling compute clusters, and establishing state-of-the-art data centers. They are laying the physical foundation for the future of artificial intelligence at an unprecedented pace. To put that spend into perspective, it's basically like buying a major professional sports franchise every single week for an entire quarter. Elon Musk actually perfectly encapsulated this ultra-aggressive capital allocation strategy on the earnings call with one incredibly bold statement. He said, "We are investing as fast as physics allows." He made it crystal clear to investors that maximizing near-term earnings, that is simply not the objective. He views AI infrastructure as rapidly becoming one of the most valuable assets in the world, and he's willing to spend literally whatever cash is available to capture that future. Musk repeatedly hammered this point home. Maximizing today's earnings is just not the goal. Instead, he's looking toward a $100 billion annual revenue run rate by the end of this year. And then, an absolutely audacious $1 trillion run rate by 2029. Let that sink in for a second. $1 trillion. They honestly believe they can scale the top line to $1 trillion in just a few short years if they just keep executing. And it's exactly that massive scale of ambition that is driving this historic capital expenditure. President Gwynne Shotwell completely echoed this relentless forward momentum. She cited major progress on Starship V3, growing government demand, and even noted that SpaceX is still just getting started. Despite already reaching this incredible scale, they are intensely focused on pushing Starship forward, driving down launch costs through even better rocket reusability, and enabling massive orbital infrastructure. Basically, they are building the highway to space that will support both global communications and these massive future AI networks. But while the executives are firmly focused on building this massive infrastructure for the future, Wall Street fundamentally operates in the present. Investors absolutely love a grand vision, but at the end of the day, they model their investments on quarterly spreadsheets, free cash flow, and near-term risk. And that brings us to the reality check. Despite beating expectations with an earnings per share of -9 cents, which, by the way, was significantly better than the expected -26 cents, that massive AI spending meant SpaceX still posted a net loss of roughly $541 million for the quarter. It's just simple math. You simply cannot spend almost $16 billion on infrastructure in a single quarter without taking a massive bite out of your bottom line. So, synthesizing this entire market reaction, the stock basically fell because of a perfect storm of anxieties. First, you have the sheer unprecedented scale of that AI capex. Second, those continued quarterly net losses on the bottom line. Third, there's this distinct friction between management prioritizing long-term expansion over the short-term profits that a lot of investors were heavily expecting post-IPO. And finally, there's a looming technical factor on the horizon. Compounding all of this anxiety is an upcoming lockup expiration. This is a major headwind for sure, because even if company insiders don't sell their shares immediately, the sudden addition of over $100 billion worth of eligible shares can severely pressure the stock price. It's a massive increase in potential supply, and the market very often front-runs these events by selling off in advance just to avoid the incoming wave. Ultimately, what we're left with here is a massive financial tug-of-war. On one side, you have a visionary company willing to spend tens of billions to build the world's most valuable assets, seeking an enduring competitive advantage at a literal trillion-dollar scale. On the other side, you have investors terrified of execution risk, weak current cash flow, and the stark reality that meaningful profitability might actually be delayed for years. As we wrap up this explainer, I'll leave you with the billion-dollar question that the entire market is wrestling with right now. Will SpaceX's aggressively huge AI investments secure an enduring competitive advantage, or will they just delay meaningful profitability far, far longer than anyone expected? The operations are flawless, the revenue growth is historic, but this capital allocation is arguably the most aggressive we have ever seen. What you really should take away from this is that SpaceX is not playing it safe. They are betting the entire house on the future. So will a trillion-dollar ambition justify a multi-billion-dollar burn? That is absolutely the narrative to watch in the coming quarters.